This is mostly very interesting. It's in the end of the day, everybody's a bit tired, but still this is like everything comes together. Yeah, that's fine. Please.
Have a seat.
Urs will do the moderation together with Scott.
So I suppose this is what's
Wherever
known
you
as
wanna
the winner's curse.
Yeah, but they don't have a
guess.
microphone.
Okay. So welcome on stage again, and congratulations, of course, to be picked as the winners of each round. I have a first question to you. You're in the exit business, so you don't live on dividends. So most important for you are the exits. Is it important when entrepreneurs come to you that they already have an exit strategy, that they already have a potential exit partner in mind? Anyone?
Should we just
I think it depends. Anyway,
Should
it
be on.
depends on the stage of the venture investor and of the company. So for me, I'm investing mostly at seed stage. I think it's a bit optimistic to think that a company at seed stage has figured out how they're going to exit. So we're more focused on them building a great product and a great business, and later on you can worry about where the exit's going to come from.
Yeah.
Want a second opinion?
Yes, please. And the third one.
The answer for us is no. We look at does the team and the entrepreneur do they really solve a problem, or is it a disruptive business model, changing the entire business? Ideally, they have made some opinions about exit in the future in the back of their mind. But if it takes too much room of where are you going to sell your company for, then we start with the end first, and that doesn't make sense so far. When we do some internal estimation on potentially who could buy a company in a few years, but it's definitely not the main focus at that early stage.
Okay. Any controversial answer?
Yeah, I'll be a little bit controversial, a little bit with DN, and even more so with respect to Silicon Valley VCs in general. In DN's case, if someone doesn't know their industry well enough to know who the key players are in that industry who could be potential acquirers, that's a red flag for us. It's not that they've thought through how they're going to exit, when they're going to exit, at what valuation or otherwise, but they need to at least understand their market and understand who the key players are, who are the players who are likely to want to grow through acquisition as opposed to be a stodgy player that's never going to buy them. So they need to have a general understanding of those things. But more controversial than that, if you think about what's made Silicon Valley great over the years, it's a company like Cisco where the corporate development team knows the 5-year business plan, and then they leave Cisco and join a VC firm. And then they find the people who were at Cisco who are willing to leave and build the gaps in that 5-year plan, knowing that if they are successful, Cisco is going to buy them back into their company. So in those cases, you've got this ecosystem that builds out where the entrepreneur, the VC, and the acquirer all are part of the same family, so to speak. Now, unfortunately, in Europe, we don't have much of that yet. And what will make Europe successful in many ways is that ecosystem developing. We see a little bit of that here in Germany, effectively, through what's been created through rockets, but only to a little extent because it hasn't filtered into the acquirers, only into the people coming out and the VCs having come through the same ecosystem. But if we really want European venture to be successful, I think it needs to copy a little bit of that in some capacity.
Yeah.
I have a twist. I mean, when we look at companies, we always ask the exit question up front. And I've had several exits in my career where the buyer, unfortunately, was able to put a gun to our head and say, wouldn't you like to buy this lovely company that we have or wouldn't you like to sell that lovely company that you have in your portfolio? If you decide to sell it, we'll offer you a good price. If you decide not to sell it, we'll become your worst enemy, and we're kind of a nasty enemy. So one of the things we consider when looking at a company is how big is the likely universe of purchasers, and is it so closed that there might be a buyer who could put the gun to our chest, and we try to avoid those cases. The other thing we talk about, it's almost a joke in our partnership, is, well, could we IPO this company someday? And it's a joke because for most of the last 10 or 12 years, the IPO markets in Europe at least have been closed, so why do we talk about it? Well, it's because in the event that the IPO market is open and it becomes irrational, which has happened in my career history a couple of times, in fact, it's the best time for venture capitalists. In fact, there's a joke about what the prayer of the venture capitalist is at night, and it is, "Dear God, may there be another bull market in technology stocks in my lifetime," because as we all know, in 99 and 2000, you could sell really flaky companies for enormous amounts of money, and you didn't even have to have much substance behind it. And so we'd like to think, at least, that a company that we invest in could be IPO'd if the markets are so kind as to open back up. And on the flip side, we do not like to invest in companies where the IPO, or excuse me, where the exit is likely to be limited to a small number of investors who could hold us up.
Okay.
Yeah.
Thank you.
And so we have a later stage fund, and when we're looking at companies that are in the mid double digits in terms of revenue, you want it to be an exit path within a few years' time. Obviously, you don't have to have a planned exit when you come to us to look for funding, because in that event you probably would have gone with that exit plan already. When it comes to having strategics as acquirers, as to your point, we have made investments in some companies where there were a small stake held by a strategic. That can be dangerous because it might be difficult to exit someone else that is a competitor to them. So that is obviously something that we're looking at as well.
Well, all the entrepreneurs here are looking for funding. To come together with an investor can even be worse than marriage because it's one-sided. So the investor can divorce the entrepreneur, but the entrepreneur can not really divorce the investor. What would be your ultimate advice for all those entrepreneurs before they decide if they have the choice between different investors? So what would be the most important thing to do the due diligence from an entrepreneur side?
I mean, if I can start, we often ask the companies we want to invest in, we let them talk to whoever they would like to pick from our portfolio, and it can be speak to a company that it went really well for, speak to one that was pretty good but maybe not the best, and speak to one where it didn't really work out. And you essentially need to do the due diligence on the investor as well, and talking to our portfolio companies is probably the best DD you can do.
Anything to add here, or?
We have the same approach. In addition to long-term perspective on where we put our names on, reputation, and in addition, we know by the time we sign an investment, we cannot sell the company without the entrepreneur, and we haven't, and we will never sell the company without the buy-in of the entrepreneur, because the acquirer in 99% of all the times needs the entrepreneur and his buy-in. And vice versa, the entrepreneur needs the VC to become happy that he signs the exit as well. So that's, I think, the one most important thing to keep in mind on both sides. So far, we have made good experience on both sides. To look into each other's eyes and say, we are going to do this jointly and no one can escape.
Yeah, but when talking about the exit, then it's already direction to a success story, of course. So from an entrepreneurial side, my advice would be that you really talk to the portfolio companies, that you talk to the CEOs, especially to those who were not the most successful in their portfolios, because then you really need more help of the investor probably. Then in good times it's always good, and the sun is shining, then it's fine. But when you're not doing good, then you really need the help.
And don't forget that as you're doing an investment with a particular venture investor, you're going to be the entrepreneur and the investor are going to be spending a lot of time together, and that's important. You got to make sure that you feel like there's an understanding there. So I think it's just time. Just make sure you spend as much time as you can with the people that are going to be investing in you.
So, yeah, but especially, sorry to put a following question to that, especially when it's not really going well, then of course the investor tends to spend less time on those companies.
Well, I'd be surprised.
Yeah.
Sometimes the opposite is true. I mean, I think that's a generalization, because sometimes when things aren't going well, it's not necessarily the entrepreneur's fault, and there can be situations, depending on what the circumstances are, where the investor and the entrepreneur are spending a lot of time together in a difficult situation.
So I would just say for an entrepreneur, they need to think about entrepreneurship over their career. So one of the worst things that can happen to an entrepreneur is the company is not performing well, and their venture investor encourages them to stay on far too long. Whereas the right thing for them from a career standpoint and from that VC relationship standpoint is to say, it's not working, there's a little bit of pool of capital left, let's shut down this idea and you can back me on my next idea. One of the great cases of this, for example, is Ev Williams, who was working on Odeo. Odeo was going nowhere. He bought back his investor's stake. The investors came back and backed him in his next startup, which was Twitter. So you shouldn't necessarily think about it as just saying what happens in the worst case scenario. Also, you shouldn't think about it as just being one-sided. Right now in Europe, because there's a lot of people with entrepreneurship, a lot of, very few VCs, the power is one-sided to a large extent. But I know of an entrepreneur in the Valley who very recently told one of his angel investors, you're not doing enough for me, I want you to sell your shares back, because one of my new investors for the Series A needs a certain ownership stake, and they can't get it just putting money into the company, so they want I want them to have your shares because you're not adding value. In the Valley, in some situations, if you're a serial entrepreneur and your business is getting a lot of traction, the power is all on your side, and the investors have to come to you. Complete flip of the situation here. So think about entrepreneurship not for this startup, next startup, next startup, next startup, if that's the career path you want to pursue.
Thank you. Do we have any questions from the audience? Yes? Do we have a mic?
Hello, I'm Pedro. This is kind of on the sequence of the difference between the US and Europe. I just got back now from San Francisco, and one of the things I've noticed, and some of the VCs who are here might actually be the exception, is the reason why, and this is the question, why do you think that there is the tendency for the startups in the US to be incredibly ambitious and with this idea of changing the world and really revolutionary? And here, I kind of get a feeling that the startups which are more fundable are those who are a bit more realistic, a bit more, in 3 or 4 years we'll be acquired by those guys by $20 or $30 million. But in the US, you get more of a feeling of the guys who get funding are trying to change the world, are trying to do something really revolutionary. My question is, why do the alphas, so the really high risk, high returns, tend to go to the US, and then those who are a bit more conservative tend to end up in Europe? Or is this completely a false premise?
I could talk a little bit about that. What you're referring to is a Silicon Valley phenomenon, not a US-wide phenomenon. There's debates going on between, is New York resurgent, is it not, is Boston still a viable venture market? But on average, when we see deals on the East Coast, and particularly when we see deals that are not in LA or San Francisco or the Bay Area, they are not as ambitious. Something about the ecosystem in Silicon Valley creates people wanting to change the world. Partly it's because they've seen others who have done it successfully. Partly it's because there are VCs at different stages, so not just seed VCs, but VCs with $300, $500, $800 million funds, NEA billion-dollar funds, who are willing to write $50 million checks to help you take over the world. And they know that if they're successful getting the seed money, getting the A money, there's this big check that will help them succeed. That doesn't exist in most of the US. So it's not just, Europe is not ambitious compared to the US. Silicon Valley is its own little bubble for those sorts of things. How do you change that? Well, you need European IPOs. And you need IPOs where you have people who then leave that IPO and do another IPO after that, so that you have a series of people who have created world-changing businesses that are the icons that others can look to. And I would say Berlin has that more than almost anywhere in Europe today. So,
I asked myself that question when I came over here to Germany and when I became a venture capitalist. I think a lot of the answer has to do with culture. I mean, I grew up in a suburb of Chicago, and there was a guy in our suburb who owned 6 McDonald's restaurants in the 1970s, and he drove around in a Jaguar and went to the golf course, and he made millions every year from his 6 McDonald's restaurants. And this guy was a guy where we, you know, were saying, wow, that's great. And he wasn't shy about kind of showing off. And you come to Germany, and it's almost a social problem if you made too much money. The people here who made a lot of money, you may not even know their name, and they don't want to be in the press, and they don't drive around necessarily in big Jaguars, and you've probably never heard of many of them. So I think a lot of it is culture, and part of our issue over the years was, well, are there any megalomaniac Germans based on the history of this country, you know, that we could find that really want to make a huge billion-dollar company? The answer is yes, but there's just not as many of them as there are in the US. And that, frankly, is the reason that we reject most of the deals that come across, because a very credible business plan exists to build a 17.8 million revenue company in 6 years with an EBIT of 10.7% in a niche. I mean, and it's probably going to come true, but it's not a venture deal, as Dr. Nago said from Early Bird. I think it's culture, a lot of it.
I think the culture is on both sides, if you agree, on the entrepreneur side as well as on the investor side. I see where in the US, an investor who sees an entrepreneur who failed twice, he says, well, he knows everything not to do now, and he didn't do the mistakes with my money. So now it's time to invest if the idea is good and the team is great, whereas in Europe probably the investors are a bit more hesitant to invest because it's actually that cultural problem.
I think it's changing too. I mean, I'm extremely encouraged in the last 3 years. I'd say the percentage of the deals we're seeing with more ambitious people is changing, and Berlin has something to do with that, I think, definitely. You can feel it.
I mean, so just one thing. On that point, I mean, what we are doing at Index, we've raised $1 billion in the last 24 months to invest in these big innovative ideas. Around 60% of our investments are going to Europe and 40% to the US. It might be more difficult to find companies in Europe, but they definitely do exist. You know, there are certain phenomena such as fashion technology that started in Europe. Net-a-Porter, for example, was a European business. Farfetch, another of our portfolio companies, is a model that the Americans are now copying. So, you know, it does exist.
Quickly, for each of the investors, because we're running out of time, I know as an entrepreneur, we spend most of our time sitting hunkered down in our caves and seeing news on TechCrunch as to what companies are doing well, and probably half of it is skewed by the PR world. What technologies are you guys seeing that excites you, or sectors that you guys see that excite you right now? And which are the sectors that you think are just absolutely overfunded, overcrowded, and that you think is probably like, is where you don't want to be?
There's some geography here. You know, e-commerce still works well in markets like Germany where logistics are fantastic. E-commerce, for generalized e-commerce in Silicon Valley, is a no-starter for most deals unless there's a heavy social component built in like a Winello, or unless there's a brand being built like a Warby Parker. The stuff that I get excited about right now is the intersection between stuff that's happening physically, particularly health-wise, and things that are happening within mobile and social technologies. So for example, there was a company recently funded where they could take an inhaler if you had asthma, and it would be able to create a mobile phone application so you could track what was going on around you when you needed the inhaler and be able to model that out so you as an individual could figure out should you change your behavior in order to require, you know, this aspiration less. Those sort of interactions have never been, you know, modeled out before. They never existed, and they create really exciting opportunities to create disruptive businesses.
Are we going down the row?
Yeah, let's do it.
All right. We've been and continue to be very excited about mobile-related investments. We invested in a Berlin company called Gate 5, which we sold to Nokia in 2006. We did a mobile device management company called Ubitex, and a mobile social gaming software company called Scoreloop, which we both also sold successfully. At the end, Scoreloop had 50 million users. They now have 200 million users. And we're now invested in a mobile advertising verification company here in Berlin called AdEven. So we like mobile, and we think that it continues to be an exciting space, obviously being driven by macro trends, just the smartphone and tabletization of the world. And so we really love that space and like to look at ideas in and around it. What don't we like? I mean, I think we're not the best consumer internet investor, I would say. It's just a crowded space. There's a ton of incubators who do a great job. You know, there's Rocket, there's the Rocket spin-offs, there's, you know, just a lot of really good expertise in that space, and we don't think we add a lot to it, at least not in the early stages of it. And so it's hard for us to be a player at that point. If it's a little further along, it's more capital intensive, that might be something that we could look at, but it's not a space where I'd say, yeah, you know, send me your consumer internet deal.
So I wouldn't say we would avoid consumer internet for us, but I would say if you're involved in consumer internet that the bar keeps rising every year very high. So, you know, what people used to get excited about in terms of active user numbers is, you know, you probably should revise upwards what the current expectation is for what is deemed a successful consumer internet proposition. So you just have to realize that they're exceedingly difficult. So I think we're a little wary, but we like consumer internet, and but it certainly, it keeps, you know, the trends keep tipping upwards, you know, almost on a quarter by quarter basis as to what success is defined as. But in terms of things that I like, I'm seeing a lot of B2B mobile stuff where people are finally starting to figure out how to put together successful business models around apps on iPad for business use. And I think that that's going to be the start of a decade-long trend. There'll be interesting things there. And another area that I like that's maybe more vague, but there's sort of, and I think it's an area where Europe can be particularly good at, is what was it 2 years ago that the world tipped to where now more people live in cities than don't. And there's going to be a whole category of sort of apps and services to help human beings cope with living in mega cities where we're packed in like ants and really we weren't designed to live that way. And I think you're going to see technology play a role in how that plays out. And I think that, you know, frankly, Europe is maybe a more urban area than the US, where you have Silicon Valley is a big suburb. No offense to Silicon Valley, from California, so I'm used to that. But you know, cities give you a different perspective on things. And so the interesting technologies that are going to be city-based are going to come from cities.
We are currently excited by these disruptive business models that help people to save money and help small and medium companies to save money. One is the very common example of terminals for card transaction, where companies like SumUp come in and cost reduction is 90 to 95%. So everyone is benefiting from it. So old industries get replaced by things getting connected. And there's one small company that really touches my heart, and I really love it, because it's not only that they potentially make a good exit, but it's beneficial for the environment. It's a small device. It's not like Nest. It's a bit comparable in the same space. It's connected to your heating device at your home, and this device is then connected to the internet, and of course then on your smartphone you have an app. And once you leave your home, by tracking where you are, the system collects massive data and knows when to shut down your heating system at home. And let's assume you drive home and you approach your house by 3-4 kilometers, then the heating device gets connected and starts to heat your house. So the company is Munich-based, called Tado. It's at very, very early stage, but every customer who installs the system saves 30% energy. And if we speak about all the politicians, they speak about climate objective and trading CO2, and that doesn't change anything. And if everyone was going out installing that device, like Germany could immediately meet all climate objectives. And that's really beneficial, besides money.
Plus,
Technology you don't like?
plus the co-investor is great on that deal.
Is that you?
Working together?
And that's so much fun because we have a great co-investor. Things we don't like, we have an opinion that a few investments are probably a bit overhyped, but why giving our opinion we might be wrong, so let others invest where things are overhyped and we'll see, maybe we might be wrong.
Oh, come on, give us one. Be wrong.
Let me think about it.
All right, we're going to come back to you.
Okay, so while we're thinking about it, earlier on I spoke about some of the investment themes that we're pursuing for the time being, and we're all looking for asset-light models with good consumer or customer engagement, high margin structures, and with that in mind, we're investing a lot in companies in the cloud and SaaS space, so Zendesk, Dropbox, looking at marketplaces which can be very liquid. Take Funding Circle, which is also in financial services, Etsy. Investing in big themes such as infrastructure for the enterprises, which we believe is going to continue being replaced in the big corporations. E-commerce is still an area that we're looking to invest in. There again, looking at high margin structures and very good engagement with the customers. And on the opposite of that, companies that have very high service levels, maybe kind of also very capital intensive in the hardware space, clean tech are areas we have been less active in the last couple of years.
Do we have time for a last question from the audience, or are you coming on board for the final words? One last question over there, please.
Last time I was in the Valley, we were really excited about meeting with a very well-known ski until we found out they wanted $3,000 a meeting. I've seen that trend carry over here a little bit. I've seen some evidence of it, but I'm not familiar with it. I'm surprised because I've seen it twice now. Any comments or?
I couldn't hear you.
That's crazy. Avoid it at all costs. I mean, there are some places where they will put together an event and then charge entrepreneurs a big amount of money to come.
That's crazy. That's a scam.
That's crazy. That sounds like a con artist.
Kurt, will you charge $3,000
like a new
to
business
meet with
model
a startup?
I'll actually buy lunch off it.
Yeah.
Goes the other way here in Europe. I don't know.
Great. Well, listen, on that note, I'd like to thank all the panelists for being up here and hand it over to Arjun, who can close the event.
Okay, thank you all so much.
Thank you.
Give him a big applause, yeah.